I'd like to welcome everybody to this iteration of the SIBA Forum's webinar series. We're very happy to have Gordon Liao with us, who will talk about stablecoins and DEXs. Just some background, Gordon is a chief economist at Circle, who we know from the USDC token, the digital representation of the US dollar. And he's responsible for shaping the economic agenda of the firm. Before joining Circle, Gordon was at the Federal Reserve Board as an economist, and he's also been involved with the fixed income portfolio management at Harvard Management Company, and he led research at Uniswap Labs. His academic work has been published in the RFS and the JFE, and he holds a PhD in economics and a bachelor's in applied math from Harvard. We're very excited to have you here, Gordon. And how about I'm just going to hand over the floor to you, and we'll go with that. Now, before Gordon starts, sorry, one more thing I should say. If you have questions, please put them in the Q&A. I monitor the Q&A, and I will interrupt Gordon on occasion to ask any clarifying questions. Gordon will speak for roughly 40 minutes, and then we have a Q&A until we adjourn at 12:15. Gordon, now the floor is yours.
Great. Well, thank you so much, first of all, for inviting me here, and Andreas for hosting this and helping to move the discussion along. Let me share my screen here. So this talk is focused on stablecoin and DEXs. Why do I talk about these two topics? Not only because I worked at Uniswap Labs and now I work at Circle, but also I think these are the two most important parts of crypto, of decentralized finance, but I would say of crypto overall. Payment stablecoins are arguably the first killer app of crypto, more broadly speaking, because it has a real world utility function of providing payment services. But beyond that, I think understanding the risk and opportunities involved with stablecoin is a really, really important topic. I speak from DC right now, having done a round of meetings with different policymakers and having discussed a lot of these issues. So I think this is a real opportunity for the academic community to study these type of opportunities and also risks, but in a quantifiable manner. And so the first part of this presentation will focus on a new paper I released about 2 weeks ago on tokenized cash and liquidity and risk considerations. Now, a significant part of this discussion in the second part will focus on DEXs. I would say that DEXs are arguably the second killer app of crypto. It really represents innovations that's beyond just faster instantaneous payment, rather it's programmability of money. And later on, as I discuss, the combination of payment stablecoin or tokenized cash along with DEXs is a truly unique innovation in itself, in that it provides the trading of FX, one of the largest market in the world, to be on-chain, on blockchain. And as we see, as I'll show later, on DEXs, the largest traded pairs are oftentimes stablecoin pairs, either stable to stable pairs or stablecoin to ETH and some of the larger coin pairs. So let me just jump into the first paper. By the way, this is posted on SSRM. Feel free to take a look. I will go over a condensed version of this paper, focus on the risk and opportunities of tokenized cash. I would say this is a first attempt at using on-chain empirical data, or at least one of the first attempts to really quantify the run risk and liquidity risk that exist in tokenized cash. And I do a comparison of the liquidity risk that exists in tokenized cash with what we traditionally think of as liquidity risk in banks. So firstly, I think for this audience, it's no surprise. I assume everyone understands what stablecoins are. There are crypto assets that have a peg to usually the US dollar, but could be other fiat currencies. And the growth of stablecoin has been incredible over the past 2 years, 2.5 years or so. As you can see, this is the circulation of the 5 major stablecoins over the past 2.5 years. And you can see that, in the recent 6 months or so, there's been quite a bit of divergence in this growth. Previously, it was all of them going up. Of course, you had the Luna Terra crash, which also had knockdown effects on the circulation of Tether versus USDC. Full disclaimer, I work for Circle currently, so we issue USDC. And I think these newer divergence of growth of stablecoins and changes in circulation are representing the revealed preference of users and revealed preference that you can read from the demand, which actually reflect the underlying qualities and attributes of different type of stablecoins, which I will talk about next. So in this empirical paper, one of the things I do is actually just spell out the different types of stablecoin, which oftentimes are often bucketed together. And I think that's actually too gross of a generalization, because not all stablecoins are created equal. Just like in traditional assets, they're not all what seems to be fixed income assets are created equal. This particular work is focused on tokenized cash, which is defined as tokens with full reserve backings of cash and cash equivalents, that is with T-bills and other HQLA level 1 securities with maturity of less than 90 days. Or right now, some part of tokenized cash is backed by commercial bank deposits, with the eventual goal that maybe those commercial bank deposits could be in part replaced by direct access at the central bank in terms of reserve at the central bank. Now, this contrasts pretty sharply with other forms of stablecoin, tokenized deposits, which you might have seen JP Morgan as their JPM coin, which is internal. There are a few other banks launching their own versions of stablecoin. They rather call it tokenized deposits because it is based on fractionalized reserved bank deposits, which I think has a lot of interoperability issues, because one JPM coin is not the same as one, say, Bank of America coin, because you don't have necessarily the standardization of risk and leverage across banks. Of course, the next category is Tether, which has fiat asset backing of varying credit and maturity quality, and liquidity. I don't need to speak too much about that. There's a crypto collateralized stablecoins like DAI and V. Again, I assume this audience know what these are, but these are generally over collateralized stablecoin, but with really, really volatile collaterals, such as ETH. Lastly, algo stablecoins, which is they are now infamous for ushering the crypto winter. And recently, the terminology that's been used, at least in DC, is endogenously collateralized stablecoins, which I think is really, really appropriate, and it separates out DAI from Terra, given the fact that one of them is exogenously collateralized and the one is endogenously collateralized. Some of the things I look at in this paper are, one is just general asset correlation. How do stablecoins behave relative to more volatile assets? So in this case, this is the return correlation of market cap versus the return of Ether. And you can see that tokenized cash in general, which are USDC, but as well as BUSD, tend to have a lower correlation with asset prices. USDC actually has almost correlation close to zero, slightly negative, but practically zero. BUSD has lower correlation with ETH as well, relative to other more volatile type of stablecoin that are either collateralized by crypto itself, which makes sense, that it has higher correlation in terms of circulation, or even Tether, which is widely used in trading. And we can also see this fact of lack of correlation just by looking at the time series. So this graph on top, it shows the balance of USDC by wallet type that are logged into exchanges, smart contracts, and EOAs on Ethereum, as well as at the bottom panel is the ETH price. During this sample period of 2021 to more recent last couple of months, ETH price has fluctuated up and down, whereas the circulation of USDC has largely been insulated. Later on, I will talk about, there is a substitution effect between amount of tokenized cash held in smart contracts versus EOAs, but largely the overall circulation of tokenized cash has been insulated from the price of crypto assets, which is really interesting fact to point out, because there's a lot of arguments for some people would say that stablecoins are poker chips in the crypto casino. I disagree with it just based on the data. It doesn't seem like it is at least fluctuating with the asset prices. In addition, the amount of tokenized cash that are logged into exchange wallets are rather limited, roughly representing less than 10% of stablecoins in circulation, or in this case, USDC in circulation. That's not necessarily true for other stablecoins. Roughly a third of this goes into the different wallet types. This is using a combination of script data from Etherscan, as well as some internal data of wallet address labelings that Circle has on different type of wallet profiles for holders of USDC. We can see that the large portion, over 50%, are held in EOAs, or externally owned accounts. These are individual wallets as well as institutional custodied wallets. Those are custodied through, for instance, Fireblocks, which is a custody solution provider, or even Anchorage, these type of institutional custody providers. Relative to the amount of stablecoin or USDC that are held on omnibus accounts in exchanges and VASP, they're relatively small. There's only 4.6 billion out of roughly 50 billion that are in exchanges. The other large categories of where at least USDCs are held are one, bridges. These are cross-chain bridges. By the way, this is all for Ethereum. So the amount of USDC held in Ethereum is about 80%. For bridges is roughly 5-6 billion out of these around 50 billion are held in bridges. And these are cross-chain bridges, oftentimes to layer 2s. DAO treasuries hold quite a bit. I want to focus on these two pillars. One is stablecoin liquidity. These are largely curve pools or Uniswap stablecoin to stablecoin pools, which are liquidity pools on DEXs that are providing interoperability and exchangeability of one particular stablecoin, such as USDC to Tether, as well as other DEX, other lockup of liquidity indexes, which is roughly 500 million or so. That is the amount of USDC that's locked up for trading against ETH on decentralized exchanges. Andreas, do you have any questions?
Yeah, so I was just about to interrupt you. So there's a few questions that we have in the chat. They are of a relatively general nature, and I have a question of my own too. So let's start with Geoff Zhang's question. And so he asks, regardless of whether the tokens are fully backed or fractional reserve backed, you have to trust the central counterparty to hold these reserves. So once you have trust in a counterparty, why not have the traditional counterparty handle the transactions on a traditional platform? Why do we actually then need to decentralize?
Yep. So that is a very good question. And this is why later on I will touch on decentralized exchange, the real innovation there. when you have traditional counterparties such as a bank holding assets, they're still very limited in the interoperability of usage. If you take example of banks that have API services, these API services are so limited that you can barely interact with them. Take a platform like Plaid. Did you know that Plaid mainly use screen scraping as a way of logging into connecting with your accounts on banks? So part of this decentralization is just making open banking API widely available. And then there's other parts of decentralization, which is about inclusiveness, bringing more users on board, allowing developers to develop more easily, and not subject to restrictions by banking relationships or setting up a formal contract. And these contracting frictions are actually quite significant. As we observed, the evolution of banking has been relatively slow in the adoption of technology.
Okay, and then the second question that we have is, and I really apologize, Alexa, but I can't pronounce your last name. But he basically says the following: how do you see the existential risk of tokenized cash category, as their business model is dependent on the interest rate available on, say, T-bill, to place in a reserve and get upfront interest on that? So those rates are out of the issuer's control. If at some point they go to zero or negative, as they were in Europe for some while, would that put tokenized cash into a category where people try to seek more risky yields?
Yeah, so certainly you need regulations to prevent reaching for yield in this industry. And Circle has always been following the proper regulations in not doing so. That the business model question is a challenge that I work on in my formal capacity. But there's a variety of other ways of making money from this. Right? There's a large network effect. There are ways of building applications or API services on top of minting and burning, of providing account services for certain type of users. So I would say interest rate, net interest rate margin is currently the predominant way, but not the only way in the future.
So speaking of interest rate margin, and this is the next question that we have from Tiamak, and I'm going to paraphrase it a little bit. So now we're living in a rising interest rate environment. So as interest rates were zero, a stablecoin was essentially the equivalent of cash. But now when you actually make a deposit and obtain a stablecoin in return, the stablecoin issuer makes a lot of money, basically on the interest differential there. So which is good for Circle, I suppose. But there are some real questions that arise then about the competitive environment. It raises actually the specter of, say, traditional banks issuing also stablecoins. They could also be backed by, assets where they can make extra money on the yield. So, I would like you to, explore a little bit about how you see the development of stablecoins in a rising interest rate environment. And, the question that we have here is about possible monopoly pricing, because as you say, right, there's network effects from having a single stablecoin like USDC being dominant, but then that creates possible monopoly pricing issues.
I think the bigger monopoly issue is vertical integration of exchanges and stablecoin issuance. So as you can see, Binance recently waived their trading fees, and that's partly subsidized by their earnings on BUSD, which is their also issue. There's nowhere in finance where there's more concentration of power, more vertical integration than crypto exchanges, because you basically have an exchange providing custody service, providing trading service, providing stablecoin issuance service, and asset management service, and etc., all in one place. That is as centralized as you can get. Now, for stablecoin, it's still relatively competitive. There are new ones being launched, all the time. There is quite a bit of competition, even among the largest ones. And there are, right now there's some regulatory ambiguity, and with regulatory clarity, I would imagine there are more entrants into this market as well. Regards to interest rate sensitivity, this is very similar to Reg Q back in the 70s, where banks were not allowed to pay too high of an interest rate to their deposits. So of course that had effect on the profitability of banks as well, because at some point, there is a trade-off of, do you want to necessarily hold non-interest rate bearing payment stablecoins that has a convenience yield, but doesn't necessarily have the monetary yield. So that is something to grapple with. But I would say that the business innovation continues, and there are other ways of making monetization possible and sustaining ecosystem without purely relying on interest rate margin.
So since you're speaking of the exchanges and the deposits there and the like, and I think you wanted to say a little bit more, let me just ask a question here, which is this: is early on in your presentation, you compared USDC with, backed by high quality assets versus USDC backed by commercial paper, let's say, to break a, exactly.
Or not USDC, but Tether has commercial paper.
Tether, exactly. So sorry, that's what I meant, right? So now Tether is still the dominant stablecoin used in most crypto exchanges as opposed to USDC. So Kraken, for instance, only enabled USDC trading, I think, about half a year ago. Can you explain, do you have an explanation for why? Why is it that Tether, which is, in your view, and I think this is often a view held, less high quality than Circle or the USDC coin? Why is it that USDC has not eaten Tether's lunch yet?
Well, part of it is just they're the first. I think they launched earlier, so there is an inherent momentum, and that speaks to the network effect. And part of it is just like your dollar has this shadowy feature to it, and that's still widely used, and it's a necessary part of the informal economy in certain parts of the world. I think Tether is taking on, personal view is Tether is taking on that sort of view, that sort of role in certain part of the world. By the way, everything I say here is my views only, not those of Tether, or not those of Tether, not those of Tether, of course, not those of Circle or any other institution I'm affiliated with.
So then the last question, I'm going to push Oleg's question for later, but it goes back to what Thomas says. So Thomas says, if you have a concrete example of stablecoin for a stablecoin exchange, and I'm going to add one piece to it, which is, as far as I understand by now, the USDC coin is the biggest asset held as collateral for DAI issuance. Now, I'm not sure if this is from the peg stability module or whether this is actually part of already the deposits that people make, but what explains that?
Yeah, so that's a better question for Maker. So current state of crypto collateralized stablecoin, namely DAI, just historically hasn't been very stable without a stablecoin as a collateral. You could back it with just ETH, and historical examples and episodes have actually proved that it wasn't really stable. At some point, they depegged, and they voted to add on USDC as a collateral to ensure that the DAI could be pegged 1-to-1 to the dollar. So maybe that's a design flaw there, or maybe there's something more deeper. But I think that's a little bit beyond the discussion here. Happy to take it offline later.
Okay. All right. Okay, I'm going to let you continue now because we had a long Q&A here already. So,
yeah, I'll try to go through the stablecoin part quickly, so I can also talk about DEXs, which is where the real innovation is. And at the end, I'll show you this FX trading with stable versus stable. So one thing I do in this paper, which you all should feel free to read, is applying typical Basel liquidity assessment that banks have, but for tokenized cash, namely for USDC. I was in the process of doing this for other stablecoins, but unfortunately, due to some lack of data, it's actually a little bit harder to do. So Basel liquidity ratio, what is it? Is the stock of high quality liquid asset, which are, there's a formal definition of what qualifies as HQLA, treasuries are considered level 1 HQLA. Corporate bonds, for instance, are HQLA but has a discount factor associated with it, and etc. That denominator divided by the total net cash outflow over the next 30 calendar days. And this is where it's interesting. The net cash outflow is defined as cash outflow minus the cash inflow given a discount factor. But in Basel, there's actually no actual calculation of cash outflow, rather is kind of subject to an assumption based on the outflow rate of deposits. So for retail deposits, it's usually considered, I think, around 3% of deposits expected to flow out in the next 30 days. For more wholesale type of deposits, it's it goes all the way up to 40%. So there's a typical schedule for how Basel calculates this. Now, we can't apply it directly to stablecoin because there's no equivalence of retail versus wholesale versus corporate type of deposits. But we could actually calculate using on-chain data, applying this formula. The nice thing about blockchain data is you can actually see how much inflow and outflow in gross number that is. And that's actually quite a bit of innovation over how banks are able to calculate just their net deposits and report their net deposits. I think there's actually only one paper in the banking literature that actually look at gross inflows and outflow, and that's using special FDIC assessment data, which is not available to most people. But for instance, here is the gross inflow and outflow for USDC. As you can see, mostly the gross inflow has been higher because it's during a period of growth. But we can kind of stress test this by focusing on the gross outflow, assuming there's no inflow. So based on a number of different type of criteria, some are more strict than others, I calculate liquidity ratio for USDC to be somewhere between around 200%. If we assume some Basel standard of non-operational deposits, or using the worst 30-day observed run rate, assuming a 0% gross inflow. But if you use a more standard definition, the formula I showed you earlier, assuming there's a inflow as well, then we get some liquidity ratio that's roughly 800%, all of which are, by the way, significantly higher than large US banks, GSIBs, global systematic important banks LCR average that are recently reported. I'll skip these slides on more financial stability discussions. Basically, the main point is as stablecoins grow, it will replace certain part of say physical cash or reverse repo facility at the Fed, but not necessarily deteriorate deposit and compete with bank deposits. And also stablecoins or tokenized cash could be used for on-chain protocol-based lending, enabling more credit access. So the second part of this presentation is focused on decentralized exchange, or sometimes known as automated market makers, which are protocols that enable the provision and demand and supply of liquidity in a fashion that's based on pure smart contracts rather than based on central limit order books. So the motivation behind this work, this is, by the way, joint work with Marco DiMaggio at HBS.
Sorry, can I interrupt you for 1 second, Scott, Gordon? I just wanted to come back to one thing that you said at the end, right? So just to finish the conversation about stablecoins. So one thing that I'm wondering about is this: the Federal Reserve hates narrow banks, right? So they've repeatedly tried to prevent one from happening. Now, effectively, an entity like Circle is not a narrow bank as such, but essentially you create a narrow banking model, right? How is this not a concern for the Fed? And do you foresee that, at the moment you're small in terms of importance for the Fed itself, but eventually this could, if actually if the DeFi ecosystem would take off to the point where you have more tokenized asset and they need much more cash available to settle transactions, means that you need more stable coins, then it becomes a genuine concern. So, do you foresee that you actually bump into the Fed at some point in a meaningful way?
Absolutely. I mean, I used to work at the Fed, and that is the topic of another paper I wrote while I was at the Fed, which is about narrow banking and stablecoin and different models. I think my view has shifted. I think the views of the Federal Reserve has been shifting, informed by newer evidence. What are some of the newer evidence? For one, we have this. This is the Federal Reserve balance sheet. Negative portions are liability, positive portions are assets. You can see a blow up of balance sheet due to QE, now slightly reduction due to QT. This pink portion is really, really important and interesting. This is effectively a narrow bank. It's called the reverse repo facility, in which money market funds and banks are depositing their excess cash in the form of a reverse repo, which is a collateralized loan to the Fed, but collateralized by Treasury securities. And what does the Fed do with this? Well, the Fed just invest in Treasuries with it. Now, why do banks do this instead of purchasing Treasury themselves? Because they want the one-day liquidity, because repos are these reverse repo facilities are overnight. So we already have narrow banks, and that is non-trivial. It's roughly 2.5 trillion, I believe. And the Fed understands this and sees it as, well, this actually hasn't been too bad. So their views are changing. The other component, I think, is changing views gradually. I mean, this is kind of what I looked at before as well, is this large red portion. It continues to increase. What is this? This is currency, physical bills in circulation, 80% of which are $100 bills. They grow at a pace of around 200 billion a year, not slowing down at all. So in fact, if you tokenize a significant portion of cash, you actually end up slowing down this component, the increase of this component, and perhaps even reduce and reverse this component's growth. Just 2 weeks ago, I was at Circle's conference where we had a bunch of developers. A lot of the developers in the ecosystem are from LATAM. They're working to build neobank apps based on USDC because they're trying to solve their own problem of, to prevent devaluation of their local currency. People are holding $100 bills under the mattress, literally. So replacing $100 physical bills with tokenized version of those, which is slow down and reverse this part of Fed balance sheet. Replacing current narrow bank, which is a reverse repo facility, which is replaced this part of the pink balance sheet. So I think it's actually overall not a serious concern. And because there's already evidence of narrow banking, and they could actually reduce Federal Reserve balance sheet. The other component of why people typically are against narrow banks, by the way, narrow banking, you should really read this. I just recommend everyone to read this older papers, really known as the Chicago Plan. Started with a paper called 100% Money by Irving Fisher in the 1930s. Milton Friedman also wrote a bunch about narrow banking. It is a good solution to reduce risk in the financial system because it downsides the size of really, really large banking institutions by unbundling the payment and the depository and the credit service. The problem has always been, what do you do with this credit component? Because you still want to, banks typically provide credit. We just have two Nobel laureates who wrote about Diamond Dybvig, wrote about the credit provision and the synergy between deposit and credit. But what has happened in the last 2 decades or last decade is you've seen a proliferation of non-bank led lending. This is not even talking about crypto. This is the Square Capitals of the world, the Cabbage of the world, the lending clubs of the world that are using payment terminal data to provide loans that actually offer better underwriting experience because they have the payment information to underwrite loans. Now, what on-chain tokenized cash does is just opening up that payment-based, market-based lending to a broader set of participants that could benefit from it. So this chart I didn't go over earlier, which is just a chart of only one of the protocols, Goldfinch, which was launched recently, that provides lending and credit intermediation, but it's market-based. There's no fractionalized reserve, fractionalized banking going on. It's market-based lending facilitated by protocol. And I believe, with transparency, with reduction of information asymmetry, and you could actually provide quite significant amount of credit that replace some part of bank-led credit creation.
Okay. So I think I'm going to let you move on to AMMs now.
I know this is also this is a really, really important and exciting topic, because it truly highlights the fundamental values of programmable money, not just faster money that are tokenized with instantaneous settlement. So automated market makers, what is the main motivation of studying this? Well, the main motivation is really about efficient forms of price discovery. We know there are problems with central limit order books in that, there's a race to the bottom in terms of speed that is just not efficient for market makers or for the broader market. There's also liquidity challenges for thinly traded assets. This is something that the SEC, for instance, highlighted in their consultation to look for technology and innovation that tries to solve for liquidity challenges. Well, automated market makers is one way of providing liquidity without resorting to high-frequency trading firms. It really relies on, I would say, more passive capital providers, and it relies on the fact that you have a way of providing liquidity using passive assets that one already hold in a way that that support liquidity provision and price discovery and capital formation, and etc. I'm not going to talk about DeFi more generally, because I assume people here know enough about DeFi. But let me just dive into what this part is, this particular paper is about. This is about assessing the liquidity of AMMs, comparing it with central limit order books. Frankly, this started out as an exploration that later on was actually quite surprising even to me, to see the amount of liquidity that's available on automated market makers. And this is a key result, the main takeaway from this paper, that if we calculate something like market depth, that is a typical measure of liquidity for automated market makers, actually, strictly speaking, for Uniswap v3, which is a concentrated liquidity version of AMM, we see significantly more liquidity on AMMs relative to the spot books of Binance, Coinbase, Kraken, and Gemini. And this is a graph of a comparison of the average liquidity. I forgot what time period it is, but I think this is in a blog post I have with Dan Robinson at Paradigm, actually, with the full methodology and the code and the data all available for download. So if you have questions with methodology, I recommend you to just look up this blog post. It's on Uniswap's website, but also on Paradigm's website. What this is the plus or minus 2% market depth calculated based on the liquidity profiles of Uniswap v3 for each USDC pairs in comparison to the other exchanges. And you can see that it's really significantly more liquidity. And I think part of that reason is because of decentralization. You have anyone who could participate to be a market maker. Typically a market only have centralized limit order books only have the largest high frequency traders as market makers. But here on Uniswap v3, you literally have hundreds of thousands of liquidity provider, which oftentimes are retail, which oftentimes are smaller. And the passive way of providing liquidity allows anyone without too much knowledge of market making to participate in a very passive way. So some additional key results are, market depth is even greater for larger trades, and market depth is generally consistent intraday, which is really interesting because, as long as the price doesn't fluctuate too much out of the concentrated liquidity range, the market depth is for AMMs are relatively consistent, which is something that traditional central limit order books actually lack. In FX, for instance, usually the market, when the market liquidity dries up after New York before Japan opens, which is often a time when a lot of funny things could happen in prices and people get stopped out of certain orders or options get triggered. But with the AMM model, there is actually very little intraday fluctuation in market depth. Related literature, I'm not going to talk about how AMMs work. I think this is actually worth just spending a minute on. What AMMs are, at least in Uniswap v3, is basically the liquidity pools are, you can almost think of them as an agent. It's an automated agent that has Cobb-Douglas utility function with an alpha of a half. That is essentially what AMM is. It allows this hypothetical liquidity agent, which is a smart contract, no one's operating it, it's just purely a smart contract, to act as if they are a Cobb-Douglas utility, a Cobb-Douglas agent with a utility function that trades off, asset A versus asset B, apples and oranges, and there's a strict utility function, and it happens to be the Cobb-Douglas utility function with the parameter of 1/2. So that is what Uniswap v2 is. Now, the problem with Uniswap v2 and the constant product AMM overall, talking to this crowd, you guys all understand Cobb-Douglas utility function, is that the marginal rate of substitution is basically the price, but the liquidities are spread out. You always have this one single utility function that is constant, that's not changing. What Uniswap v3 does, so here there's some graphs of Uniswap v2, Cobb-Douglas utility function, rate of substitution between two different assets, and this is what happened afterwards. But what Uniswap v3 does is really just concentrate that liquidity into a smaller range. So you still kind of have that Cobb-Douglas utility form, but more localized, and that requires a pre-selection of liquidity range. So a bit more active involvement, but still largely passive in nature. One thing I do want to talk about is adverse selection. The question is always, as a passive liquidity provider, aren't you being adversely selected against? Isn't that the whole premise of market making, that, if you're adversely selected against all the time, then you're bound to lose to those who have informational advantages? That is true for high frequency market making, in which oftentimes there are information advantages. If you are able to, run ahead of somebody for a fraction of a second because you got the news ahead of time, say the FOMC release news goes through some fiber optic, well, not fiber optic, goes through some microwave dish quicker from DC to New York to Chicago. As a high frequency trader, you could front run others, and that is valuable information. But if you ask any of those high frequency traders, do they have any clue what the price will be the following day, the following week? They have no clue, because there is relatively more information asymmetry in prices. When the time is really, really small, there's information advantage. But when you zoom out a little bit, if you ask for what the price is, in the order of days and weeks, in this like slightly longer short-term frequency, medium-term frequency, there's really little predictability in returns. And I think that is an important point, in that there is actually less adverse selection in the timeframes of days and weeks in which these passive liquidity providers are operating. They might get arbed in a sense for really, really short-term timeframes, but in the longer timeframes that actually matter, in which their holding period matters, there's actually less adverse selection overall. there's a calculation of liquidity return, provider return, which I'm not going to go through, but basically people are being compensated on any sort of adverse selection by providing liquidity in these markets. Again, I'm going to skip this, except with the interesting note that a lot of the results in Amm'S are actually similar to old literature. Grossman Miller had this conjecture about higher the autocorrelation in return, the more loss for market makers, which actually is kind of a lower equilibrium level of liquidity, which is actually observed with AMM data as well. So much of the rest of the presentation just go through in detail how we construct this calculation of market depth, which to summarize is basically integrating the amount of liquidity that exist in a liquidity pool on V3 outwards. So adding up liquidity at every single tick and calculating what is the market impact if you were to do a trade of a certain size, how much price would change. And from there, you can calculate how much liquidity provision there will be for the price to not change by more than 0.5% or 1% or 2%, etc. And this is a typical graph of liquidity concentration and liquidity distribution for something like a ETH USDC pool, where there's some element of, people understand that you can back out a probability of distribution based on liquidity concentration, and this is a market implied market implied price distribution, if you want to put it that way, based on people's liquidity positioning. Why do AMMs work? I talked about this adverse selection issue, and the data actually shows that most of the LPs hold for longer than a day, which signals to the passive nature of liquidity provision, which also signals to perhaps a lack of adverse selection for a longer period of time. Now, I'm just going to skip ahead, and I know we should actually have a longer discussion. So market depth looks great for AMMs versus centralized limit order books. But what is really interesting to me is the combination of this tokenized cash concept and DEXs. When you combine those two together, you get essentially a FX market. FX market, as people know, is one of the largest market with $6 trillion of volume per day. And it is oftentimes one of the deepest market as well. Since the launch of Eurocoin, which is another payment stablecoin, tokenized cash that's issued by Circle, there has been a formation of a relatively small but growing market in the trading of Euro stablecoin versus dollar stablecoin. And what is unique about this is all liquidity that comes in because people are motivated to generate returns on their holdings of dollar versus euro, and passive market making actually allows some generation of yield. If you actually calculate how much fees there is versus the volatility of these pairs, the returns are actually sizable enough that I think it could actually attract institutional capital at a later point. Right now, this pool does about $1 million worth of volume every day. The unique nature of it is also is 24/7. On weekends, when there are risk, geopolitical risk, for instance, people could actually come to this market and trade against the pool and be able to obtain liquidity. I truly think that the growth of tokenized cash combined with DEXs could actually solve a lot of issues that exist in the FX market. Issues such as rigging of FX benchmark, issues such as mismatch of risk. FX settlement risk is really large, according to the BIS. Every day there's $9 trillion worth of exposure in the FX market, that are not settled through payment versus payment, which means one counterparty have paid the other counterparty one currency but hasn't received the corresponding payment in exchange. Now, this is a problem that's easily solved through blockchain because payment versus payment, in other words, in blockchain lingo, is just called atomicity, is a natural fact of blockchain-based settlements. And the ability to convert one currency to another using a transparent mechanism, I think actually could really be meaningful in terms of also even providing a benchmark during on business hour and off business hour. Now there's a bunch of issues, MEV, there's some workload manipulation that still needs to be worked out, but this is really exciting innovation, generally speaking, that I think that could be really fruitful going forward. So I'll stop there and take some.
Oh, you're stopping already? Okay, good. there's a ton of questions. So, sorry, Gordon. Do you want to conclude maybe, or
that was roughly my conclusion of tying together these two important concepts and where I see this market could head to.
Well, thank you so much. This was great. Very exciting presentation. We have a ton of questions in the Q&A. And I'm going to come to those in just a second. I just want to ask on the last part, when we think of using an AMM model for FX, you know, there's a few things that I think we have to be a little cautious about. So for instance, we're using, as you say, the Douglas, if you want, liquidity production function. We could argue whether or not this is actually the best way to do it. It's easy to code, right? But it doesn't mean necessarily that's the best. And obviously the V2 version, a V3 version of Uniswap addresses some shortcomings in some form. But just going back to you know, a more stablecoin related question is, see, if you put a deposit of USDC and USD Euro token into an AMM, what you're missing out on is all the interest nowadays, right? Because now we have an interest environment. So, you know, do you not need a mechanism by which the people who hold actually these coins receive some of the interest that say Circle collects in the process?
Look, you know, this is a tricky issue, right? We're a regulated entity and we seek to have more regulation. And the truth is, you know, even if we want to pay interest by current security rules, Circle cannot pay interest. Otherwise, it will be deemed as a security. So I think this, you know, and the fact is, if you think of tokenized cash as a replacement for $100 bills or physical cash, cash doesn't pay interest, yet people seem to hold plenty of it, more than $2 trillion of cash, and that's not interest rate generating. I don't know how much physical euro there are in existence, but there are $1,000 euro or 1,000 euro bills, physical bills, which signals that, you know, there is value for, there's a convenience yield for you know, forms of bearer instrument that resemble cash, that are tokenized. And if you compare to cash, I don't think the interest is a issue. But even for market makers, right? Market makers don't necessarily make, you know, when interest rates are higher, they don't necessarily make out the interest rate if they are deploying capital and have to have certain amount of capital that are left for.
Okay, but let me just interrupt you for 1 second. If you could take off your Circle hat for 1 second here, and put back your Fed head if you want, and not in a regulatory capacity, but in a let's see how the market would work capacity. So if you take a step back, we can say maybe the following: an AMM version of or in some form a liquidity pooled version of international exchange rates could be quite valuable, for instance, when it comes to remittances, in a variety of ways. But you know, if we set aside the existing world of how remittances work, for instance, and how interbank transfers work, on the retail side, you could do a lot of good by finding a way how you can maybe have a model, like a balancer model, where you have multiple assets together in a liquidity pool so that people can easily access it. But in an environment where there are interest rates, there are different forces at risk, not at play, that then affect the liquidity providers, right? So, the small, the person who wants to send, $200 from Toronto to the Philippines, for instance, could use an AMM, but you need somebody willing to provide the liquidity, and they need to have the right incentives to do that. So are we going to see, forgetting about the circle model as it is today, do we need to see also a model which could account for the interest which is accumulated and won at some point? Is that not necessary for this to work going forward?
I think that's an equilibrium question, right? If you have enough returns generating on AMMs, that could potentially be higher than interest rate. Last time I calculated, just based on the volume of the fee generation versus the amount of liquidity that's locked on these FX pools, they're actually higher than risk-free rate. Of course, there's some risk involved, but arguably FX risk are much lower than, say, fluctuation of crypto asset risk. So at some point, there is an equilibrium in which there is enough generation of returns for liquidity providers that would attract liquidity providers to participate, that will offset their alternative investment, so to speak, of investing in safe assets elsewhere.
Okay.
But so, you brought up a good point about serving the end users of these, right? Remittance is a huge use. Average remittance cost, according to the World Bank, is 6% globally. In some corridors, is as high as 15%. If you can just shave off a couple of percentage points, that would do so much good to the hundreds of millions of migrant workers around the world. And by the way, a lot of these are underbanked or unbanked individuals that rely on, say, payday lending and the type of services. I'm pretty sure a lot of those individuals are not getting interest income regardless. There's some stats around, I think one of the banking regulators put out like 75% of payday lender users have bank accounts, but they choose not to use bank accounts for various reasons. And these people are not getting interest rate payment through their deposit accounts. They're barely making ends meet.
No. So let me go through the questions in the Q&A. And so the way I'm going to do this now, so for the audience, is I'm going to first go through the questions on AMMs and on trading. And then we're going to go back to the stablecoin questions.
Sure.
Sorry for butting in actually with a question myself. Let's start with Job Zhang's questions, which is, do AMMs behave like HFTs in terms of stress? So do people actually actively and aggressively withdraw liquidity in times when market prices move?
Yeah, so that's actually a really interesting question that we're investigating right now, we meaning Marco and I. It appears that the minting and burning of additional liquidity is not that much. Rather, AMMs do lose liquidity in really, really stressful scenarios, but it's a passive way of losing liquidity in that, you have a concentrated liquidity range, say for ETH, maybe there's one of the early charts I showed, there's like a peak around the current price. When the price falls significantly outside of where the concentrated liquidity is, you naturally lose your liquidity, you naturally lose the market depth. But that's a very passive way of losing liquidity rather than an active way of market makers withdrawing liquidity. In fact, what you often see is just market makers don't necessarily change their position that quickly. Of course, if you look at one of my prior colleagues, Alston Adams, have shared this graph of how on ETH USDC pool there is very active rebalancing of liquidity from day to day. Yes, there is more active liquidity providers as well that are rebalancing liquidity. But I would say, at least by number, a lot of liquidity providers are not very active. There are some that are active. There's some that's less active. But I think that in a very stressful scenario, you lose the most liquidity just from the price movement outside of concentrated liquidity range.
Thank you. I'm going to quickly add that Alfred Leha's and Christine Parlow's paper, which looks at V2, basically they see that there's very little liquidity movement and withdrawal in particular across time. Now, you said something which was interesting in the last part of your answer, and that goes to a question by Peter O'Neill. And he asked basically the following: while there are certainly lower barriers to entry in liquidity provision for AMMs, there are thousands of unique liquidity providers. But when you look at the on-chain data, it appears that the liquidity provision, the quantity of liquidity provision is very concentrated. So in V2, the top 1% of addresses provide more than 80% of the total liquidity. So what's your view on that? Does this undermine the idea of democratized liquidity provision in some form? And does this actually provide, actually the question here is also, does that provide potentially some risk there for markets?
Yeah, I think, this is one step. The invention of AMMs, the development of these protocols is one step further in democratization of finance, right? By opening up the possibility for people to participate. Of course, you still have concentration, but the concentration is much less than, I don't know, a traditional centralized limit order book, in which is almost all liquidity providers that are specialized high frequency funds. Actually, there's like a good JF paper or maybe JFE paper that looked at liquidity provision on central limit order books by retail. That is, retails who are entering limit orders as a way of, I don't know, trading. They oftentimes, actually, they almost always lose in comparison to the higher frequency market makers. So I do think AMMs is a giant leap forward. Now, is it enough? That's more of a welfare question that's harder to answer.
So, and then relating to that question is a question by Oleg, and he asked basically, what are your thoughts about the institutional adoption of AMMs, also relative to the existence of centralized exchanges?
Yeah, so I think for institutions, some are starting to adopt some crypto native, market makers, but most are kind of waiting on the sideline, either from the user demand side or supply side. Because, for one, this is still early experimentations. If you think about it, Uniswap v3 was launched, May of last year, less than 18-month old. This whole space has been relatively nascent. There are important questions to be answered from a policy standpoint, from a compliance standpoint. How do you, especially for institutional adoption, institutions that have fiduciary duty, that have limited partners, they had to answer important compliance issues. And those important compliance issues might require some form of, I don't know, knowing your customer, etc., which is why we see developments such as early attempts of permissioning or early attempts of KYC, such as the Aave pool. But as an industry, I think we're struggling to figure out what's the right balance to onboard more institutional adoption in DeFi and to provide those institutions with what they need to engage with this system, yet feeling comfortable from their compliance department, satisfying regulatory needs.
Okay, so I have another question from Chiamak, which is relatively long, and I'm going to paraphrase it, so I hope you forgive me for that. But essentially, and I'm not sure if it's a man or a woman, so they are asking if there's any evidence on the relative prices, taking everything into account. So we have the liquidity on AMMs can be quite substantial, but at the same time, you have on Uniswap, for instance, you have to pay, I believe it's still 30 basis points for a trade, which is also substantial and possibly much more than, say, a bid-ask spread on a centralized exchange. So do you have any sense of the price comparison between the two?
Yeah, so, in the assessment of, I think this is in the blog post I have with Dan Robinson, there is some quantification of how much that fee is. And in overall, when we look at it, it's still cheaper if you were to execute large orders, I think greater than, I don't know, 500,000 or whatever. It still is cheaper to execute on AMMs, given the improved market depth. Now, the fees, whether it's 30 basis points, there's different pool fee tiers. There's the 5 basis point fee tier. There's a 1 basis point fee tier. I think that is something that will evolve as more liquidity providers enter into the market. There will be more lower fee tiered pools, but that's a market equilibrium question.
So I have a question on your view on maybe the effect of AMMs for less liquid assets. So, you know, we tend to focus a lot on the most liquid assets for everything. And in some sense, if you want to think of using AMMs for FX, that would be an extremely liquid market again. But I'm wondering if there's not also a possible opportunity for, you know, the kind of assets, and there are tens of thousands in the world that trade basically once every week or so or less, right? To have a liquidity pool there, and then make it more accessible for, you know, people who are interested in investing but just don't see the liquidity and worried about the ability to buy and sell those securities.
Absolutely. I noticed at the very end you mentioned securities, which is a very sensitive topic. But this is something that, yeah, I think regulators also understand there needs to be better ways of facilitating capital formation and price discovery. And this is another way in which DEXs and stablecoin are related, because stablecoins, you know, in a sense, the neo-banking approach is replacing banking-led intermediation with market-based intermediation. Well, market-based intermediation works when there's a market, but when there's lack of liquidity, when there's lack of price discovery, then it's harder for the market-based intermediation to function. Now, with DEXs, you could actually improve that liquidity. You could actually improve that market functioning, capital formation, price discovery. So I think this is, again, why the two are synergistic. On the one side, you're unbundling the credit intermediation function of banks. On the other side, you're improving market functions of trading thinly traded or thinly marketed securities or assets. And that is important to have both, because you can't have you know, replacement of bank-like functions without the co-development of market-led price discovery and capital formation.
Okay. Now I have 2 more questions on AMMs. The first one is actually a really interesting one from Oleg again. And so the question here is this: we obviously look at the liquidity taking side, and there could be a competition between centralized and decentralized exchanges. But he asked an interesting question about the liquidity provision side. And so he asked whether or not the real competition for AMMs in terms of liquidity provision is not actually a centralized exchange. So that would be like HFT liquidity provision, which is fleeting and really, you know, just just basic capital, but rather centralized, decentralized lending protocols like Compound and Aave.
You mean for Compound and Aave to come in as liquidity providers on DEXs?
Well, or rather for the users or the owners of these tokens, you know, they have a decision between putting it into an AMM or putting it into Aave.
Got it. Yep. I think at least on Crypto Trader, there are some discussions and proposals that were made related to, well, maybe you should just have concentrated liquidity in a certain range, and for the liquidity for additional capital, you cannot sweep it directly into Aave or Compound. That's the beauty of the composability of DeFi, right? You could actually come up with frameworks in which you are actively making that decision of whether to provide concentrated liquidity or whether to invest in or lend out your capital in Aave or Compound. And that could be actually automation. So I think that's been proposed and that's been thought of, and maybe some people are even working on this actively since they appeared on Crypto Trader.
Okay. So, and then last question, and just maybe a 1-minute answer on AMMs, and then there's a few still that I have on stablecoins, but this is from me. What do you see actually the future of AMMs? And so here's very briefly, so versus DEXs, centralized exchanges. So my view is that centralized exchanges are not needed. right? We can, if you want to have a limit order book, we can run this into in a layer 2 solution. That's better than a centralized exchange. It actually eliminates a lot of risk. So is there a future in which we have all trading, which is on chain in the form of an AMM or on a roll up, and where the centralized exchanges are nothing more than on and off ramps? And then actually the question is really, are they the best on and off ramps, or are centralized exchanges essential for the ecosystem?
I don't think centralized exchanges are essential for the ecosystem for provision of liquidity, but they are essential for on-ramp, off-ramp that you mentioned. Additionally, they are currently essential for the ecosystem for preserving privacy, in that, you kind of had to move your money to a centralized exchange almost as if they're a mixer, but they're a mixer that's KYC'd, because when you move there, if the government needs to look into it, they will ask the centralized exchange to give up your information. So they are a regulated mixer, to so to speak. I do think DEXs have the potential to be broadly applied, or AMMs have the potential to be broadly applied, not just for crypto trading, but for all of finance when things become more tokenized. But there are important barriers: blockchain speed, MEV. There's a bunch of market manipulation issues that needs to be addressed, either through either self-policing or more formal regulatory measures. Those need to be resolved, and there needs to be continued improvements on these protocols, even just for settling, not every 12 or 15 seconds, but on maybe layer 2 or some other chain that's faster, that's more in line with how information flow. Those are significant barriers, as well as the KYC type of barriers. But I think those things could be solved. The fundamental technology is really, really exciting.
Okay. Now, we only have a few more minutes left, as I understand it. And so I just want to ask a few more questions here from the chat. Moving on back to stablecoins now. Oleg has a question about the self-custody wallets. So the question is, do you have any evidence to say that people use them actually just to store their money, or is it actually that people use these for payments in USDC tokens?
Both. You can read the longer paper, and we have this size distribution of wallets, as well as I think their frequency of transactions. So it is true that for, I think, 75% of the USDC wallets, enabled wallets, hold amounts less than $100. And I think the median transaction of those wallets are, I don't know, like the median frequency of transaction is like more than 30 days or something. So definitely there are some store of value, right? Also the examples that I gave of developers from LATAM, they're trying to solve the problem of stuffing cash in mattress. They're clearly just interested in having a safe store of value, even if it doesn't earn interest rate, because their benchmark is $100 bills in mattress. Right? So definitely used for both, but the payment usage is just quite innovative in doing real-time cross-border transactions.
Okay, so two more things. So Larry made some comments about the use of narrow banks. I'm going to point the audience to his comment in the chat. I'm not going to post this up as a question, but last question, and I'm going to paraphrase the question by Pierre on USDCs and financial stability in more fragile economies. And I'm going to paraphrase it to saying is, do you see a risk that stablecoins could lead to further dollarization, and therefore also are a way how you can circumvent currency controls, whatever we think about them?
It's a double-edged sword. My personal view is, there will likely could be some dollarization, but I do believe in monetary sovereignty of smaller countries, because you do need independent monetary control. And the observation is also not Circle, but many other firms in other countries are developing their own versions of stablecoin. Some smaller countries are doing their own CBDC. So the future is unclear. There could be stablecoins in every single major currency jurisdiction, or even smaller currency jurisdictions.
Well, excellent. So thank you so much for this discussion, Gordon. I hope it was illuminating for the audience. I think we learned a lot about the intersection of stablecoins and also how this could play into the usage of AMMs going forward. I enjoyed this discussion, and I want to thank all the attendees for their support for the SIBA Forum.